Hi, I'm Kelsey Johnson, and this is my financial analyst presentation for Finance 551. First, we have the electronic shopping industry. That was the first industry that I chose, and in that industry is JD.com, Amazon, Alibaba.com, Overstock, and VipShop. And here are some summaries of the companies. Alibaba operates as a holding company, provides internet infrastructure, e-commerce, online financial, and internet content through services through its subsidiaries. Amazon began as Earth's biggest bookstore, is now the world's largest everything store, dominant cloud service provider. It owns Whole Foods and a leader in digital personal assistance providers. JD.com is online direct sales company in China, sells appliances, computers, digital products, communication products, and more. And then we have Overstock.com, which offers discounted brand name merchandise for sale over the internet. Most of its inventories comes from manufacturers stuck with overproduction, older models, or some color that wasn't as popular as the designer had envisioned. And then we have VipShop, which sells retails, branded products at discounts over the internet. Retails through flash sales in which limited quantities of an item are sold at deep discount for a specified period of time. And now we have the electronic shopping industry and their supply chain. Suppliers for JD.com, Adidas, General Mills, customers, Tencent Holdings, Tunio Corp, Young Hoi Superstores. Amazon has suppliers like United Natural Foods, Sony Corp, Toyota, and anyone that you see on Amazon. And its customers, Vodafone Group, General Electric, and then, individuals like us. And then there's Alibaba.com. Their suppliers are UPS, Unilever, Nokia, and many others. Customers include Samsung, Apple, Nestle, and others as well. Overstock has plenty of suppliers, Panasonic, Oxford, Garmin, those are examples. Customers are us, individuals who buy from them. VipShop has suppliers such as Flita Holdings, Torrid Holdings, and its customers are people like us, individuals. So first, we're going to look at the leverage for the electronic shopping industry. VipShop has a good amount of debt around the industry average. It's constantly able to afford their debt, and they can afford their debt more than any of their competitors for most of their years. Overstock has a good amount of debt and can afford their debt over anyone else for years 1 and 2, but it significantly declines after year 2, and eventually they can't afford their debt at all. Amazon is consistent with their debt. They remain around the industry average, and they can afford it for all of their years. JD.com has a very large amount of debt, and it eventually goes down, but through all 5 years, they have been able to unafford their debt. Alibaba decreases their leverage as time goes on and becomes more capable of affording their debt as time goes on also. But overall, I would choose VipShop based on their leverage ratios. They have a decent equity multiplier around the industry average, and they're more than capable of being able to afford their debt. So next, we're moving on to asset efficiency. Overstock has the highest asset turnover over 5 years, but as we'll see, and as you just saw, they're not really they're kind of, seems like they're going under. So they might be having a high asset turnover because they're trying to get rid of all of their items since they're not really having much of a profit. Amazon, JD, and VipShop holdings remain around the industry averages, and Alibaba has an extremely low asset efficiency for the industry. Overall, just looking at this ratio, Overstock is the best choice, but there are competitors definitely, but we would need to look at other ratios in order to figure that out. Next, we move to profitability, and we look at the profit margin, ROA, and ROE. Firstly, profit margin, and Alibaba has the highest profit margin. VipShop is the next. Amazon's is low and even negative in 1 year, and JD.com is negative in all years. Overstock goes down and eventually becomes negative. So then when looking at ROA, Alibaba is the highest for ROA, VipShop next. Amazon remains pretty consistent compared to the other companies. Overstock has a good ROA in year 1, but since then they've been declining, and they eventually go, no, they don't go negative. Well, yeah, they do go negative in year 5. And JD.com is negative all 5 years, which is not really good. And then we look at ROE, and Amazon's ROE is increasing majority of the years, which is a good sign. Alibaba starts strong and remains above the others. JD and Overstock are not looking too good with ROE. VipShop is high all years, but is steadily declining. Overall, for profitability, I would say Alibaba is most profitable at this time, with VipShops right behind it. Amazon remains consistent with profitability ratios, but they're not exactly doing the best in the industry, and Overstock and JD are not doing well with profitability at all. Next, we move to ROE decomposition. As we saw from the previous slide, the ROE for Amazon is increasing majority of the years, which is a good sign. Alibaba starts strong, remains above the others. JD and Overstock are not good, and VipShop is high but declining. And now we need to break down the numbers to figure out, what's driving these ROEs and if what they're driving on is, good and something that their management can control and is up to them as to why their ROEs are the way they are. So Amazon's ROE is determined to be driven by their EBIT margin and their asset turnover, which is really good because that means that they're keeping their operating expenses down and they are doing well with turning over their inventory and getting their products moving. So Alibaba's ROE is driven by their tax burden, which isn't really good because the corporation can't control their tax burden. Their asset efficiency is low and their EBIT margin is high, but it seems that it's to be driven with their tax burden, not really their EBIT margin. JD Com's ROE is driven by, there wasn't really much information, I couldn't really figure out JD Com's, but Overstock's is driven by EBIT margin, which is beneficial because they're keeping their operating expenses down, but it is low for the industry and it continues to decrease. So VipShop's ROE is driven by their equity multiplier and EBIT margin. They're using leverage, and compared to the industry, they are using an above average amount of leverage, but as we recall from their times interest earn ratio, they are capable of paying off their debt. Their EBIT margin also drives the numbers a bit, and their EBIT margin is high for the industry, which is a good thing because they're keeping their operating expenses low and they're using their leverage to their advantage and they're very much able to afford it. So based on just ROE, VipShop, I think, is doing the best. Now we look at market value ratios. Amazon has a low PE ratio but a high market to book. Since their market to book ratio is high, it means that the market thinks highly of their stock, but some may consider it overvalued and may not be willing to pay for it. When looking at the PEG ratio, we can determine whether the stock is actually overvalued or undervalued. And looking at Amazon's PEG ratio, it does seem like they are overvalued. For the years that Alibaba has information, as you can see, some of it's not there. The market does like this stock, but the PEG ratio is not given, so I'm not able to, determine to me if it's overvalued. But, looking at, they are a good company, so it may not be, but we can't determine it for sure. JD.com has a consistent market-to-book ratio, staying around the industry average. In year 2, their PEG ratio is extremely high, meaning that their price was way above their fair value of the stock. In year 5, their PEG ratio decreases significantly, which could be the result of their stock price coming down to a level more reasonable with their actual value of the firm, or the firm went up in value to make the stock price a buy worth the price. But they were kind of struggling in other areas, so I don't really think that that is the case. Overstock's PE ratio increases across all 4 years, while their market-to-book ratio decreases. When comparing this information to the past ratios we have looked at with Overstock, this is probably because the firm is losing value and the market is starting to realize it. But their price for stock remained the same, therefore making it overvalued. When looking at the PEG for Overstock, we can determine that it is overvalued due to the PEG ratio being above 1. VipShop has a high but decreasing PE ratio. Their market-to-book ratio begins at a high level for the industry but tapers lower and lower. When looking at the PEG ratio, VipShop is the closest to being traded at a fair price for year 1, and the other years they are undervalued. Therefore, I think VipShop would probably be the best stock to purchase based on market value ratios because they are undervalued and they are doing well in other areas. So they would be a good buy because they should be going up in value as people realize, their actual worth. And now we move on to economic value added spread. All companies at some point have a negative EVA spread, so it just seems like that's something that goes along with this industry. Seems like the whole industry is struggling to add value to their companies, some more than others. Alibaba and VipShop have positive EVA spreads years 1 through 4, and then year 5 they kind of taper off. Alibaba is doing well 1 and 2, but 2 to 5 they're dropping and eventually become negative. VipShop eventually becomes negative in 5 years. They maintain a high EVA spread while the other companies are struggling in years 3 and 4. I like this quality because it shows that their management is doing well while there's a struggling time for others in this industry. Now we move on enterprise value and enterprise value multiples. All companies except for Overstock have increasing enterprise value for the most part. Overstock's is decreasing and VipShop's is remaining about the same, but lower than most of the other industries. Enterprise value multiple information is not given for every year of every company. Amazon's remains around the same level. Alibaba is decreasing. JD.com is overall high. Overstock drops and then increases, and VipShop continues to drop. When looking in combination of the enterprise value and enterprise value multiple, I think Alibaba is the most promising company. They have an extremely high enterprise value for the industry, but they also have an enterprise multiple close to the industry average or below for the years when their enterprise value multiple is given. The enterprise value multiple decreasing leads me to think the company is undervalued. Either they are increasing their earnings without significantly increasing their operating expenses, or they are decreasing their operating expenses and keeping similar earnings. Either way, this indicates that Alibaba is doing well. And now we have our overall industry winner, which I think most of everyone I would probably purchase VipShop. And I think this because they have a good amount of debt, which is around the industry average. They're consistently able to afford their debt, and more so than their competitors also. Asset efficiency is consistent across all 5 years and remains around the industry average. VipShop is first or second in all profitability ratios, and their ROE is driven by their EBIT margin and leverage. They're very capable of affording their leverage, so their capital structure is working for them, even though they have more leverage than some other companies in the industry. When looking at market value ratios, VipShop is a good stock to purchase due to the fact that it is most fairly priced relative to their value, and a buyer might actually be buying something that is worth less than its fair value. While VipShop eventually became negative in year 5, they maintain a high EVA spread while the other companies are all struggling in years 3 and 4. I like this quality because it shows that their management is doing well during a struggling time for this industry, as I said earlier. Their enterprise value multiple drops, so either they are increasing their earnings without significantly increasing their operating expenses, or they are decreasing their operating expenses and keeping similar earnings. Either way, this indicates VipShop has a good management team and they know what they're doing. Okay, and now we're moving on to the personal care industry. And in this industry is Medifast, Nutrisystem, Regis Corporation, Ulta Beauty, and Weight Watchers. Medifast combines physician-supervised weight loss programs with nutritional supplements and patient education programs. It is internet-based and has medical practitioners to work with you. Nutrisystem provides members with a weight management program that incorporates online counseling, individual dieting, and exercise plans. They market meal replacement products, which can be found like at Walmarts and different things. They also sell prepared meals delivered right to your door. Regis Corporation operates and franchises hair and retail product salons. They provide hair care services as well as hair care products. They are also a leader in beauty salons and cosmetology education. Ulta Beauty operates a chain of beauty stores which offer cosmetics, fragrance, skin and hair care products, and salon services, which we have one of in Hammond. Weight Watchers provides weight control programs. They offer subscriptions for commitment plans that give their clients access to Weight Watchers meetings and online subscriptions. They also give their members guidance and access to supportive communities to help enable them develop healthy habits. Medifast had no supplier information given. Nutrisystem didn't have any suppliers, but they listed their customers such as Walmart, Kroger, Amazon. Regis Corporation's suppliers are L'Oreal, Procter & Gamble, and Henkel, and their customers are Walmart. Suppliers of Ulta, Estee Lauder, Coty Inc., Unilever, and a lot more. And then their customers are individuals like us who walk into their store or order their products online. Weight Watchers has suppliers such as Cranswick PLC and Greencore Group PLC. Their customers are W.M. Morrison Supermarkets, Colruyt, and Axe Food. And now we're moving on to the leverage of the personal care industry. Most companies in the personal care industry stay around average for their leverage no information was given for Weight Watchers. Times interest earn ratio for Medifast, Nutrisystem, and Ulta are not given. Weight Watchers and Regis Corp are given. Due to the lack of information, it's really hard to determine, who can and can't afford their debt. We see that Weight Watchers can, but they also don't have it, so it's just not really reliable just looking at leverage. Then we move on to asset efficiency. Nutrisystem is the most efficient with their assets. Medifast is the next highest. They're remaining around the industry average. Most of the others are close to industry average, with Weight Watchers having the lowest asset turnover. Next, we move on to profitability. Weight Watchers' profit margin significantly decreases over the years, while most of the others have increasing profit margins or they remain around the same with little fluctuations. Nutrisystem is increasing and around the averages of the industry. Ulta fluctuates very little and has a profit margin above average for all years. Ulta's ROA remains consistent, above average, and positive. Nutrisystem is increasing over 5 years. Nutrisystem's ROE is increasing all 5 years. Ulta's ROE is high and consistent across all 5 years. Medifast is increasing as well. Regis Corp is negative most years. Now we're going to move on to ROE breakdown. First, Medifast's tax burden is driving their ROE. Next, I determined that Nutrisystem's EBIT margin is driving their ROE, which is really good because they're keeping their operating expenses down. Regis Corp was determined to be driven by their EBIT margin, which is another good thing. They're keeping those operating expenses down. Ulta's is driven by their EBIT margin, which is also good because they're keeping their expenses down. Could not determine Weight Watchers, and based on the ROE breakdown, I would say Ulta, just because they have a very consistent ROE and their ROE is driven by their EBIT margin. I like Ulta when we're looking at just ROE. Next, we look at the market value ratios. Medifast has an increasing PE ratio and an increasing market to book. Nutrisystem has consistent PE and market to book for years 2 to 5. Regis price earnings is increasing and the market to book stays consistent but is low for the industry. Ulta's is increasing, their PE is increasing, and their market to book. Weight Watchers has a price to earnings ratio that is very inconsistent. And looking at the PEG ratio, Medifast remains consistent and is close to be traded at what they are actually worth. Nutrisystem is at first considered overvalued, but then comes down to being closely valued at what they are thought to be worth. Regis Corp is overvalued for the industry in years 1 and 2. Ulta is consistent and is close to being traded at what they are worth across all years. Weight Watchers is undervalued for a majority of years, and looking at the breakdown of the market value ratios, Medifast might be ideal when looking at only market value ratios. The stock is undervalued and would be a good buy. Their market value ratios are increasing across the year, so the market is becoming aware Medifast is a good buy. So buying now would be ideal because more and more people are going to start catching on that this is a good stock. So buyers could beat the wave by purchasing now. Next, we look at their economic value added spread. Every company except for Regis Corp is doing a good job with their EVA spreads. They're all adding value to their companies. And Nutrisystem is growing significantly, as well as Ulta Beauty, which is good that they're, adding this extra value to their company when others, might not be. Weight Watchers and Medifast are inconsistent across all years, although every company, with the exception of Regis Corp, has a positive economic value added across all years, which having the positive economic value added spread really, it's great to have a higher one, but it's also great for it to just be positive because that means that you are adding value to your company. And looking at the EVA spread only, Nutrisystem is doing pretty well with adding value to their company. Next, we're moving on enterprise value multiple and enterprise value. Medifast, Nutrisystem, and Regis Corp have a below average enterprise value when comparing with the industry. Medifast, Nutrisystem, and Ulta have an increasing enterprise value across the 5 years. Weight Watchers has lower but increasing enterprise value multiples. Nutrisystem decreased from year 1 to 2, then stayed consistent from years 2 to 5. Regis Corp has a low enterprise multiple. Ulta remains consistent. And overall, I think Medifast is increasing across all 5 years, and they might be undervalued more so than the others. So I really like Medifast when we look at this one. like I said, because it's undervalued and their other ratios are pretty good, so it might be a good time to purchase them, because it looks like other companies in the industry, they're overvalued, and Medifast is too, but not as much as the other companies. And for this industry, I chose Medifast as their winner. I would invest in them more so than the others. I think they have a leverage that is average for the industry. They have the second highest asset efficiency, and they are also above the industry average for asset efficiency. Their profit margin is above average and increasing overall. The ROA is high, the ROE is increasing, and their ROE is driven by tax burden, which is not good, but they have high and consistent numbers in their EBIT margin and total asset turnover as well. All the stocks kind of had, one thing wrong with them, and I know ROE is a big part of it, but I thought that their EBIT margin and their asset turnover was good enough that they are still driven by good qualities that, management and their company has. The stock is undervalued and would also be a good buy. Their market value ratios are increasing across the years, so the market is becoming more aware that Medifast is a good buy. But buying now would be ideal because more and more people are going to start catching on that the stock is good. So if you buy now, you can beat the wave, and hopefully your stock will gain value, and you're already in with a lower price. So the high economic value added spread is also a good quality of Medifast, although it's not the best for the industry. Just having a positive economic value added spread is good. And they have an increasing enterprise value and an increasing enterprise value multiple. And I determined their 2017 price to earnings ratio is 30/48, and it is estimated to increase in 2018 and decrease a little in 2019. On the contrary, earnings per share is estimated to increase every year. The price went up from 2017 to 2018, or it's planned to go up in 2018, and as of right now, it's up almost to this amount. And as of now, like I said, it's reading around 171, which is close to the 2018 estimate. In 2019, the price is projected to go down a little bit, although still significantly higher than their 2017 trading price. They are growing very quick. And between the two industries, I determined that Medifast was the overall winner. I think I like this industry a lot more than the electronic shopping industry. It doesn't have as much foreign competition. It is a good industry where people are becoming more and more interested in weight loss programs and becoming more healthy. I think that this industry will continue to boom, or at least remain constant, and the more and more that they are growing their company, the more potential that they have to just become more valuable. And purchasing their stock now is nice because they're not as well known as they could be yet, so I think they have a lot of potential to grow.